The prediction market for a Fed rate cut just had one of its biggest single-day drops in months. We're talking a 14 percentage point collapse, from 56% down to 42%, in just 24 hours. And nearly $2 million changed hands on this move. Something big happened. Let's break it down. 3 pieces of news hit this market at once. First, inflation came in at 3.4% against a 3.1% expectation. That's not a small miss. That's the kind of print that makes the Fed nervous about moving too fast. Second, Powell's remarks at a Jackson Hole preview were notably hawkish, not the softening tone markets were hoping for. And third, 2 actual FOMC voters went on record pushing back against near-term rate cuts. When voters speak, markets listen. All 3 signals pointed the same direction. The Fed is not cutting yet. So what does a 14-point move actually tell us? Before today, the market was pricing a Fed cut as more likely than not. 56% is past the halfway mark. At 42%, that same cut is now the minority view. You've crossed the threshold from probably happening to probably not. And with $3.15 million in liquidity sitting in this market, that's not thin noise. That's real capital moving on updated information. Traders didn't panic here. They updated their forecast based on hard data. Here's where it gets interesting. The smart money flow signal on this market is sell. That means the larger, more sophisticated participants are net exiting their yes positions. They're not buying the dip on this rate cut probability, they're dumping it. When you see a 14-point price drop combined with a bearish flow signal, that's as clean a read as prediction markets give you. The market isn't confused. It's repricing with conviction. This kind of repricing isn't new. In 2023, every time inflation surprised upward, Fed cut probability markets shifted hard and fast and didn't bounce until the data changed. Markets that crossed below 50% typically stayed there for weeks. The 2022 to 2024 hiking cycle is full of false pivot moments. Traders priced in a cut, got pushed out, then priced it in again. A hot inflation print plus a hawkish Fed speaker is a pattern this market knows well. So what breaks this market one way or the other? Watch the next CPI print. If inflation stays hot, this probability could slide well below 30%. If it comes in soft, there's room to bounce back toward 50%. Keep an eye on the FOMC minutes too. Dissent language from voters could be a catalyst either way. Subscribe for real-time alerts whenever markets like this make a big move.